Conventional is great for those with a 20% down payment, but what about first-time homebuyers who want to put less than 20% down? I'm going to share with you the 3 conventional loan programs that I think are great for first-time homebuyers. You want to buy your first home, but maybe you don't have 20% to put down or perfect credit. That's okay. If you're committed to a home purchase, then I'm here to help you do just that, maybe even sooner than you thought possible. My name is Scott Wynn, and I am a licensed mortgage advisor in Colorado with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together we'll make it happen. There are 3 conventional loan programs that I like when it comes to helping first-time homebuyers. First up is a true first-time homebuyer program. Conventional reduces the minimum down payment from 5% to 3% down in the case that just one of the borrowers on the loan is a first-time homebuyer. And a first-time homebuyer means that you haven't owned a home in the most recent 3 years when it comes to conventional financing and determining whether or not you qualify as a first-time homebuyer. Now, there's nothing really too fancy or unique about this program other than the fact that it has a lower down payment, 3% instead of the 5%. But there is a drawback, and the drawback is mortgage insurance. See, the less money you put down, the higher risk there is to the lender that you may default, and therefore the cost of mortgage insurance goes up. If we take a look at this chart, you'll see that there's going to be a difference between the 5% down conventional loan and a 3% down conventional loan. It's about 0.2 to 0.4% higher in mortgage insurance depending upon your credit score. So if you have a credit score of, let's say, under 720, then you might consider FHA as an alternative option to conventional financing. In fact, I recorded a video talking about FHA versus conventional, as well as a video talking about why I think FHA is a great loan program for first-time homebuyers that you might want to check out if that's the case for you. Next up is Freddie Mac's Home Possible program. You don't have to be a first-time homebuyer to use the Home Possible program, but I think that it lines well with what first-time homebuyers are looking for in a home loan. Home Possible requires just a 3% down payment. But unlike the first program we talked about, this program has certain income limits that you have to be at or below in order to utilize it. The income limits are at 80% of area median income. Freddie Mac actually has a lookup tool that you can plug in an address and it will tell you what the maximum income limit is for the area you're looking to purchase. One major advantage of the Home Possible program is lower cost mortgage insurance. Now, if you take a look at this chart, what you can see is that on the first program we talked about, the 97% conventional loan, there's a higher mortgage insurance coverage. However, on the Home Possible program, we get to go down one level to the 25% coverage, which will reduce the cost of your mortgage insurance just slightly. So if you fall under the income limits and you're looking for a great conventional loan option with just 3% down and lower cost mortgage insurance, Home Possible may be a good solution for you. The third program is Fannie Mae's version of Freddie Mac's Home Possible program, which they call Home Ready. Basically, it's the same loan as Freddie Mac's Home Possible. Everything is the same. 3% down payment, 80% of area median income limits, and lower cost mortgage insurance. One question you may have is whether or not conventional is going to be better than FHA when purchasing your first home. Well, conventional loans carry one major advantage over FHA financing, and that is cancelable mortgage insurance. See, with FHA, mortgage insurance sticks with the loan for the entire life of the loan, assuming you are doing a 30-year fixed with minimum down payment just 3.5%. With conventional financing, on the other hand, mortgage insurance cancels at the point that you reach a balance of 78% of the lower of the purchase price or the appraised value. For most people, that will occur at some point between around year 11 and 15. For first-time homebuyers, this may not actually matter much because most first-time homebuyers aren't going to live in the same home for 10 to 15 years. Instead, what I see is that many first-time homebuyers are moving up somewhere between the 5 and 10-year mark, which means they're never going to reach the balance based on making minimum monthly payments to actually have the mortgage insurance drop off anyway. So instead of considering this as a reason to select conventional over FHA, my suggestion would be to look at the loan terms instead, the rate, the mortgage insurance, and therefore the monthly payment when factoring in whether or not you would select a conventional loan over an FHA loan. So there you have it, the 3 conventional loan options that I like for first-time homebuyers. Did I answer the question you came looking for? If not, leave your question in the comments below and I'll be sure to reply. And if you found the info helpful, I'd love a click on that like button. If you're serious about making your first home purchase, then I've got a ton of great info for you to help make that possible. Check out these other videos as you work towards buying a home. Or you can call or text me, and I can help you directly.